Good morning, Abu Kartuna. Why did you sit on the only available chair? Are you going to leave me standing during the time I am teaching you? It is a shame on you, Ya Abu Kartuna. Erase Farnawani, do not forget that I will be a member of the company's board of director and I need to situate myself in a prestigious scene. This is what the chairperson advised me to do. Ya Abu Kartuna. Ya Abu Kartuna. He wants to isolate you from your own people and make you feel arrogant. This is the starting point for the inescapable failure. In the next session, I will invite you for dinner in a prestigious restaurant. You can call it a business dinner. Oh my God, we have lived to that moment and seen Abu Kartuna, whose prettiest dream was to be able to pay for 2 small sandwiches of fool and Taimia inviting others today for a business dinner. That is ridiculous. In the last session, you spoke about a perpetual inventory system, and I expect you to speak today about a period inventory system. Is this correct? You are right. In the periodic inventory system, inventory and cost of goods sold are updated at specific intervals, such as quarterly or annually, based on the results of a physical count. Bookkeeping is simpler under this system. Thus, entities of relatively inexpensive and homogeneous items, such as grain dealers that have no need to continuously monitor their inventory and cost of goods sold, generally use this system. How do we account for inventory under a periodic inventory system? Under a periodic inventory system, 1. Goods bought from suppliers and other items related to inventory cost are tracked during the period in a separate temporary account, which is the purchases account. 2. The beginning inventory balance remains unchanged until the end of the period when the purchases account is closed. 3. Changes in inventory and cost of goods sold are recorded only at the end of the period, based upon the physical count. Could you please give an example to know how each of the 2 inventory systems operates differently and arrives at the same results at the end of each period upon physical count? The example is, Azuz's entity January 1st, Year 2 inventory consists of 1,000 units with a cost of $5 per unit. The following are Azuz's entity's Year 2 transactions. April 1st, sold 600 units for $4,800 in cash. May 1st, purchased 250 inventory units for $5 per unit in cash. The year-end result of physical count was 650 inventory units. What are the journal entries for transactions of 1. Sales and 2. Purchases and 3. The results of the year-end physical count under both perpetual and periodic inventory systems? For the transaction 1. Inventory sale of April 1st, under a perpetual inventory system, 2 journal entries are to be made. Entry 1. Debit cash account for $4,800 and credit sales account for $4,800 to recognize the cash sales transaction. Entry 2. Debit cost of goods sold account for $3,000, being 600 sold units at a cost of $5 each, and credit inventory account for $3,000 to recognize the reduction of inventory associated with the cash sale transaction. However, under a periodic inventory system, only entry 1 above has to be made, because a periodic system does not continuously update inventory or cost of goods sold accounts. Entry 2 above is not required to be made after sales transactions. What is the entry to be made for the transaction 2, the purchase of 250 units on May 1st in cash? For transaction 2, under a perpetual inventory system, the journal entry is to debit the inventory account for $1,250, being 250 units purchased at a cost of $5 each, and credit the cash account for $1,250. However, under a periodic inventory system, the inventory account remains unchanged until the end of the period. Therefore, the journal entry under a periodic system is to debit the purchases account for $1,250 and credit the cash account for $1,250. What are the journal entries that have to be made upon the inventory physical count at the end of the year? After the physical count, no journal entry is needed under perpetual system because the physical count equals the amount of inventory on the books. 1,000 units at the beginning minus 600 units sold plus 250 units purchased equals 650 units. However, under a periodic system, the following entry has to be made. Debit inventory at the year-end for $3,250 to recognize the 650 units physically counted at a cost of $5 each. Debit the cost of goods sold account for $3,000, being the difference, and credit inventory at beginning for $5,000 to close this account, and credit purchases account for $1,250 to close this temporary account. How do we arrive at the cost of goods sold amount of $3,000? The cost of goods sold of $3,000 has arrived at by adding the inventory beginning balance of $5,000 to the purchases during the year of $1,250 and subtracting the year-end inventory balance of $3,250. Note that the perpetual and periodic systems have the same result. However, under the periodic system, amounts of inventory and cost of goods sold are updated only at the end of the period after the physical count. Thank you. Now you can sit on the chair.